Good afternoon, ladies and gentlemen. A very special show today on Market Masters and an equally special, if not more important guest. We are welcoming Mr. Sandeep Tandon, the founder at Quant Group, and of course, one of the finest watchers of capital markets. Mr. Tandon runs a very well known AMC, Quant, manages about 93,000 crore rupees and pays equal, if not more, emphasis on practical quantitative methods of investing and trading as much as he does on fundamental research. Namaste Sandeep ji, a very warm welcome. Happy New Year. And the market, which has started on a very strong back foot in 2025, is creating all sorts of problems for retail investors, for mutual fund investors. People are very keen to hear your view on how to navigate this volatility.
So I tell you, see, we have been very vocal right from July 2024 when we first spotted a deterioration in the macro factors. Okay, I'm talking about more from an India perspective, and we were very early to talk about a mild risk-off period. And come September, October, our liquidity situation also started deteriorating cuts because money started shifting from India to China because we are both part of MSCI emerging basket. That's the first point. And even the mild risk off becomes slightly more intense, and that's the reason you have seen a slightly deeper correction. Now, let's understand where we stand now and how to navigate, let's say, 2025. Okay. First of all, for larger picture, let's understand larger perspective because though every investor look from a longer term perspective and they have a reasonably good risk appetite because they have made good money in last 4-5 years, but when market correct for, let's say, for few months or few quarters, some amount of psychological barrier comes into picture. The it's a just a pressure because unwarranted returns have been extraordinary returns have been generated in last many years. So it's a very natural that human mindset be slightly more vulnerable at this point in time because they were not prepared to do so. So let's understand the larger picture first. So something has changed for India. Okay, we remain very constructive. If I have a 5 years horizon, 10-year horizon, for Indian equity market is extremely bullish because we believe that India P multiple will remain elevated for longer period of time. Okay, why I'm saying that because the India perception has changed and something got changed for US in 1960s or what got changed in 1990s, 92 in China market. And that's the way we stand today. So this could be few decades opportunity for India. There's a much larger perspective. That does not mean we are trying to play a marketing gimmick out here. Just to get a perspective, a long-term, a very constructive background. Now let's look at from 2025 perspective. Keeping in what is the two biggest risks in 2025? One thing I have highlighted that our last many years performance in the market is because of expectation levels high. This is the biggest risk we have. We have to tone down this unwarranted extraordinary returns which we have generated in last few years. I think that has to be rationalized. That's the one biggest risk. And second thing, because of regulatory changes as well as global changes, the impact cost in the equity market, Indian equity market has risen significantly, which also there's a second important risk because small buying, selling has much more damage on the prices, both the ways possible, in the upside also and the downside also. That's a two important thing. Now, if I have to talk about from 2025, I think 2025 is all about two important factors. I have to look at the macro perspective. One is the global currencies and the one is the global yields. Okay, these two will be the deciding force as compared to any other parameter. So first most important thing, let's say last many years we have seen geopolitical volatility was high because of Israel issue or Russia, Ukraine. Post Trump coming into picture, we have talked about the geopolitical cycle has peaked out, which means next few years perspective, market looks good. Now coming to what is damaging right now is that the dollar index, because the noise or narrative which is being talked about, and on the weekend also we have seen Trump has raised some tariffs. So this year the tariff related challenges will come, and I always said that we have to understand both the short term and long term objective of US also. In the short term perspective, knowing Trump or whatever narrative has been built in the in the system globally. It's all about he will the noise which will make the overall volatility will remain high, which means you will see sharp swings in the market, not only in India but more from a global perspective. So the biggest risk is about DXY. If DXY's rally, let's say it's closer to 110 mark where it corrected earlier, and it will decisively breach, and if it's 100 headed toward 118, 121, that's a one big risk you have, which means currency depreciation of USD INR can continue. So that's the first important aspect we have to keep in mind. And if I have to say one step forward, in fact, India risk appetite, which peaked out in July, something similar we are in the US right now. In fact, US risk appetite or complacency indicator, which we track it very closely, are peaking out, which means vulnerability for US equity is much more than the global equity, despite the Trump's narrative and noise which we are seeing in the market. Vulnerability, if you ask me as of today, which is the highest in from a near term or let's say a quarter perspective, I think it's the US. So we should be more worried about US than India. In fact, India has already covered maybe 60% of the risk off environment. So, and hence, before we get into a risk on environment, maybe it can happen by end of March or mid-April sort of thing. So I will like to wait and watchful how the terms narrative plays out. And in the current context, I should be buyer in select names, particularly large cap, mega large cap. I think some amount of selling exhaustion is also visible from the FIs. And if I have to say, if the biggest worry today's market, the continuous selling of FI, I think we are seeing early signs of exhaustion, which means in next 2 months' time, this cycle also should peak out, and hence, and nobody can buy exactly at the bottom of the day. So what we are looking at this stage, that I'm constructive on Indian equities from medium term perspective, keeping in mind that this year belongs to large cap and mega large cap, and hence focus is out here. Because if, let's say, if the risk of cycle lasts for another 2 months or 2.5 months, which means there could be more correction can happen in mid and small space. Now I will move to the second important aspect about Indian equities, is about the budget. Now, this background budget came, and I think it's a very mature budget, very well balanced, okay? And this is the first time government has understood the need of the hour. Let's consumption was struggling, the urban particularly demand has come off significantly. It was need of the one to boost the consumption. I think government has taken right step, very well balanced budget, and I say they have adapted the prevailing environment, and hence not only people are looking just 1 lakh benefit which you got to income tax, it has a huge multiplier effect. Okay, not only from the economy perspective, if I have to say from white economy, it also has a probability that a lot of large black economy which is there in the system and also will get converted through this route, because it's a very easy, 12 lakh rupees, there's no tax. A lot of people who have cash generation will move to it. So it's a longer term, very constructive. If this is the background which has been set, and I think what we have to do, rebalance your portfolio in a small manner, more tilted towards consumption name, more tilted to domestic names, okay? And I think everything should be fine. And extraordinary, and if I have to say where we have cautious, all those stocks which were the darling of the market for last 2-3 years, extraordinary hype has been there in select mid and small, certain segment of the markets. I think those are the areas one should remain cautious. Otherwise, I think it's a buy on dip strategy for next 2 months perspective.
Okay. Mr. Tandon, this was a very exhaustive answer. And I have two sub questions from this one. You mentioned that the dollar index will be the biggest fear of 2025. It is already at 109 and it shows all signs of going beyond 110. Now, if it were to go to your medium term target of 121, what will it mean for the Indian rupee in terms of levels it could breach, and what will it mean for the Nifty?
See, again, I'm saying this is the probability, okay, which I'm not ruling out. And we have been saying right from August, September of last year that dollar is the biggest perceived risk. At that time, it was the perceived risk. Now it is the known risk. Okay. Now what we have to understand. Let's understand tariff for a while. Okay, because noise on tariff related is very high. Okay. Yes, if tariff goes up, it will distort the overall global trade balance. And the first casualty will be the currency market, means currency and yield markets will become more choppy. Okay. Now, if you also understand the longer term implications of tariff For US itself is quite bad. Their inflation can go beyond their control. It's not like they manufacture everything, but it's a Trump style. Like any businessman make lot of noise initially and then he will happy to settle. So I think he is creating that background. And if I have to read him correctly, my personal view is that in next 3 or 4 months, the noise level will be so high. Finally, he will also settle down. And the risk which you talk about, dollar index, which I talked about initially, ultimately, if US also wants to become as a manufacturing base for the global market also, I think they also need a weaker dollar. So from a longer term perspective, whatever he is doing does not make sense. But maybe sometime you have to demonstrate, take some harsh steps which can damage you, and hence you come on the table and settle it. And if you really look at in the context of India, okay, the lot of noise is there. What today, if he's generally talking about if your trade imbalance is more than $50 billion, then I'll put the tariff. So India, the differential is slightly on the lower side, right? Close to 40 or $42 billion differential. So I don't think we qualify. Assuming we qualify even for 10% in certain categories, okay, which generally I think India is given enough indication that they will accommodate them. So I think it's a business call. I don't think one should be too much worried about it. I'm worried only on the currency related challenges rather than the tariff, because ultimately currencies is not now which is started depreciating. Right from September, global currency, both developed market as well
Yes.
emerging market currency, are depreciating from September, October onwards, and that is something which has lead to even the selling pressure which we have seen now. It has been intensified because of purely on the rupee front. Once the rupee stability comes, all this question mark on the FI selling will also settle. And anyway, government has taken a way, it's a very pragmatic budget. So I think India should, and look at the narrative, which was buy on dips, now sell on rallies. Everybody was very gung-ho, everybody is very bearish. So all background is getting built, which is
Yes.
required for a bottoming process. But when it happens, people don't believe it. So my personal view is that in next 2 months time it will happen. Stock specific, sector specific is already happening in somewhere. I think I will look at more so stock specific also rather than sector specific. I think many stocks are clearly giving the inflection point, their signs of bottoming out. I think I'll be buyer in some of these names.
Okay. Now, Mr. Tandon, you are the flag bearer of momentum investing, both as a brokerage house as also at the AMC level. You've clocked up phenomenal returns for medium to long term mutual fund holders at your level. And we are now at a stage when all the momentum counters that were once the market darlings have now exhausted their rally for the medium term. Even your biggest play, which was the Reliance Group across the asset management company, is at a 52-week low, if not worse, in the case of Geo Finance. Now, how are you navigating these two challenges on behalf of mutual fund investors in Quant AMC?
Uh, So first, let me explain to you I think we are definitely not a momentum house as you described. So in the larger interest of view, let me clarify, we are not a momentum house. We don't do momentum trading. We actually buy and sell stocks on the extreme inflection points. We
Okay.
are largely a macro and behavior house. So extreme inflection points, I'm a buyer or seller. So that's the first clarification. We don't trade momentum. If we were trading momentum in last 6 months, mid and small was in the showcasing very extraordinary rise, then we should have been beneficial. Rather, we underperformed and underperformed because it's a part of a strategy, because we felt risk profiling has changed and we are student of risk first. And we always say we are in the business of risk management, returns are byproduct. You manage your risk better, returns will be generated on its own. The first point. Second point you said about, see, generally we don't comment on the stock. What we can only give you perspective. Last 4 years, mid and small has outperformed the Nifty and the large cap, maybe close to 30%, 40%, 20%, depending on the thing. Broadly, 25-30% outperformance has been. I think that cycle has reversed. Now, time has come where, in next 12 to 15-month perspective, if I have to say, I think mid, large, and mega large will outperform mid and small. And again, I'm talking more from a relative perspective, not from the absolute perspective. And most of our portfolio in last many months when we saw risk off, we have moved from illiquid to liquid. We have moved from high beta to low beta, and we have moved from mid and small to large and mega large cap. So that's the strategy which we have followed. And I think the way we understand risk and the way it should be, we have done the appropriate steps. Sometime in the business of risk, we also you have to be slightly ahead of the curve when it comes to identifying the risk. If you are late, then it can damage your portfolio in a big way. And again, sometime underperformance is a part of a strategy, because in risk on environment, we always say we generate extraordinary returns and keep it for difficult time. In risk of environment, safety is first, liquidity is second, and returns are third. Okay, in this order we follow. So in risk of environment, it is very difficult to quantify exact bottoms. This is the phase when we see early signs of disturbance. We are the first house who will respect these data points, because we are slave of analytics, we are slave of data. So if data is changing, we have to rebalance our portfolio. There is no choice. That's the way we have done in last many years, and we have generated extraordinary returns for investor in last 5 years. So you don't have to look at sometime only 6 months or 1 year perspective. If you are invested in the market, 5 to 10 years investment horizon definitely should have. And if you look at 5 years cycle, then we are still in the top quartile in most of the categories which we operate.
That's a fair enough qualification of your investment strategy. Now, Mr. Tandon, comes the most crucial part. There were many parts that were left unsaid in the budget but were there in the document, and that's resulted in a very sharp sell-off in the same market darlings that you talk about. Now, what does this essentially mean? Have we again got back to the valuation game, where value is the most critical employment or most critical function of an investment decision? Or will there be a time after 2.5, 3 months where again the rally will return, the risk on trade will come back? So what should investors do in this case? I see many names in your portfolio where in December at least some of those favorite names have been added and built onto, especially in the defense space.
So currently I can only talk about currently. If you look at our portfolio, fact sheet has been already released on first. As of last month, we have bare minimum exposure in the defense. Only in the one of the mid cap schemes, we have some shipbuilding companies.
Yes.
Beyond that, we don't own any defense exposure. We are completely underweight on defense as well as railway at this point in time. It used to be earlier thing, but again, we are constructive from long-term perspective and appropriate time. Let's say if they correct sharply, if we get opportunity, again, I said I will buy in some of the large cap defense and the railway companies also. But from a very near-term perspective, we think consumption is the theme. And now if you look at our portfolio, we have very large consumption exposure. Hotel is another theme which become visible in the budget documents. I think that's another area where we already have position. Third, our energy, particularly renewable energy, is again a focus area. I think it's a decadal theme for us. That's a still area government has given a lot of still incentive. I think that's we still like it, irrespective of very near-term correction which is happening in the utilities, all the renewable companies in the market right now, but it remains as a theme for us. And the fourth is the larger infra names. I think people have not understood the budget. Actually, if you look at the Capex spending, overall Capex spending, it's from 4.1% of the GDP has actually moved to 4.3% of the GDP. I think a lot of people have missed out many data points. And it's not like so the Capex has been compromised. Maybe it has not given that much attention. Okay, and like last many years, the attention was extraordinary attention was given. And if on a relative basis, the extraordinary attention has become into normal attention, then I think people are slightly disappointed. I think it's a balancing act which government has done. I am remain very constructive on the larger infra thesis also in this country. If India has to grow large infra and follow, which includes some materials also, because today if you look at many metals names have corrected sharply, more from a DXY perspective and the China related sentiments. I think at lower levels, we will be buying these names.
Yes, I think metals is something that is very, very aggressively now represented in your portfolio. The other point I was trying to ask from you, sir, is when you
No, I
define.
just want to interrupt. If you look at, I think you are looking at January, December portfolio. If you look at our
Yes.
January portfolio, you will not find, we have actually pruned down this metals exposure also. But I said,
Okay.
I will be, because purely from the noise which we are expecting post Trump oath, which is playing out. But I'll be buyer in these name. I'm not structurally, we are constructive. Maybe from a very near term perspective, we have pruned down our exposure largely. But from a medium to long term perspective, I think we will looking to build exposure at appropriate time.
Fair point. Mr. Tandon, now what happens to consumption? It's one of the broadest economic themes that we have. About 60% of GDP is consumption under various heads. It could be real estate, it could be FMCG, it could be vehicles, it could be two-wheelers, four-wheelers. Even ordering food out is now a part of consumption. So, in this very broad basket, where are you hunting?
So I think if you look at that 1 lakh crore, 1 lakh rupees amount. So obviously you can't construct a house or you can't buy a jewelry in that amount. Okay. What is it going to spend? The first thing people put in the, like how the interest is there on the two-wheelers or the four-wheeler market. So a lot of people aspiration on that side. Then your consumption level moves up, you start consuming more. You can start consuming more premium segments also. Maybe it can go to the travel also. I don't think it can go to any really creating a big asset. That's not a very big amount, but it has its own multiplier effects. So I think anything which is the mass consumption thesis, okay, those are the name, should be fast moving item, should be the beneficiaries of alignment. And again, as I said, it has huge multiplier effects. So one should, if you look at a very narrow perspective, you don't get answer. But when you understand larger perspective, as I said, this could be a great opportunity. Even a lot of, as I said, the cash component of the market also have opportunity to convert into a check economy. So that aspect also people have missed out, which can further boost the economy.
Okay, fair point. So, look at small ticket within the consumption basket and look at recurring things that people might do with that extra 1 lakh rupee in their hand. What, Mr. Tandon, will you not touch in 2025?
I think, see, I tell you, we don't have a philosophy of something which I say we hate something or we are in deeply affection. Like we are like, as a house, we always say we are neither value investor, not growth investor, not or in any manner defined certain boundaries. We are an unconstrained fund house. Wherever we get superior risk adjusted opportunity, we will participate. Yes, from the current context, the erstwhile admired territory stocks for last 2-3 years has potential to underperform significantly. That's the way I will say. I will not say I will avoid or hate. I will try to see on relative basis. I will like to have either significantly underweightage or may not have any such names in our portfolio for next 12 to 15 months perspective. And if they correct further, we don't have any hesitation. If you really look at in 2020, we spotted the theme saying that in 2020, all hated territory stocks should do very well, which means value will come back. And the all admired territory stocks, erstwhile admired territory stocks, will actually peaked out. Now we are saying the erstwhile admired territory has now reached a neglected or hated zone, and hence I am a buyer in these names. So where it gives me better risk-adjusted opportunity, where my risk is limited and upside could be better. And again, this is a larger thesis. Then you do bring your macro perspective and as well as the from a valuation perspective, what it makes more sense.
Mr. Tandon, the three most critical long-term value creators in the market have been pharma and IT. Now, they are both export-oriented and focus more towards the US. What is the game plan for you as far as these two sectors are concerned? They, by the way, helped the market between September and December to sort of cushion the very large fall that could have happened.
See, obviously, both are beneficiary up to certain extent from a dollar perspective, but we are more constructive on the pharma space and the healthcare space because US cannot put too many restrictions on the generic side because their own requirements is there. That's the first point. Second most important point, the earning visibility in pharma and the healthcare space is far, far superior
Yes.
than the IT space and the, because technically, if you really look at, we don't have any edge in the IT. We are predominantly a support function sort of role, either some of the companies play or some sort of body shopping. And globally, people have moved to high-end products, platform, AI, ML sort of thing. We have yet to pick up in that area. And in the current context, if I have to say, let's say if I have to say next one quarter, if I talk about very short-term view perspective, we think US is vulnerable, and within US, technology space is more vulnerable. Okay,
Okay.
and hence, if if we expect, let's say, 12 to 15% correction can happen in the US market of a technology stock or the Nasdaq itself, then it has his own impact on the Indian technology companies also. And there's a reason we don't own any technology company for the current quarter perspective.
Fair point. And how about fresh allocation in terms of gold? When you mention about problems with the dollar index, rising volatility, tariff wars, getting dominant market share in terms of investor mind space, what will this do to gold?
So, if I have to look at gold from a longer term perspective, I think it's a very important diversification, and one should definitely have good component of precious metal in your portfolio. That's the first point. But if I have to look at from, let's say, next 2 months perspective, next 1 month perspective, I think from the current level of gold, the upside is limited. Okay. And again, I'm talking about from a short term or medium term perspective, the upside is limited, where downside could be more. As if global market becomes more vulnerable, then there could be bigger impact. Hence, I will not be very aggressive buying gold at the current level, but I will be aggressive buyer if it corrects sharply. Because as I said, 2025 will be year where extraordinary choppiness will be there. Sometimes one day you find, or 1 week's time, your gold is down 12%, 8%. Those are the days where one should be aggressive buyers.
Okay, so only on dip is what gold will glitter for Mr. Tandon.
Yeah.
One thing that has been extremely heartening, Sandeep ji, over the last 6 months is the retailers' faith in keeping this 40,000 crore SIP in top shape. Now, what is your advice to them? Because those monies were either moving to thematic funds or into smalls and mids, and we all know from watching the market for over 25 years, 30 years, that for people like us at least, that was signs of a peak building into the system. What now? Do you expect retailers to sort of hold back money, or what's your understanding of speaking to them in smaller cities?
Okay. So the way I will say, and it's not for just for a smaller city, I think it's valid for every investor in this country. What you have to, I always say that you have to keep on analyzing your risk appetite and investment horizon every peak or maybe a different cycles point. Okay, like last many months I have been talking about that we are in bull run, decisive bull run, but easy phase of bull run is over. But we are in difficult phase of bull run. And in difficult phase of bull run, everybody has to reassess their risk appetite, reassess their investment horizon. If somebody says that I have investment horizon, let's say from today, somebody is doing SIP. I have investment horizon for 5 to 10 years. I think mid and small still makes sense. Even small make extraordinary sense, because if India is going to outperform, India is one of the unique situation globally in terms of the growth rate which we are talking about. Okay, then small has to outperform, and logically it will outperform large cap. But if somebody has that 5-10 horizon, somebody is just looking for, let's say, 6 months or 12-month horizon, I think then flexi caps are better options, or multi-asset products are better option, because this gives you better flexibility to the money manager to navigate the current volatility or the current challenges much better than the individual investor. That's the second point. Third most important aspect also is to understand that SIP itself is a very de-riskification strategy, in terms of you are not putting money in one time, and you are not trying to time the market on daily basis. So monthly or quarterly or whatever timeline you have identified. your SIP. I think those should continue. The only recommendation is that at the peak of the cycle, the high risky products obviously does well, and that was the case in 2024. And if I have to look at the data from the mutual fund industry, extraordinary NFO came in the thematic segment. And when you get the highest money in the thematic, as we understand, thematic being concentrated portfolio are
Yeah.
more risky. Okay, we all understand thematic are more risky schemes or portfolio, but when the risk appetite was highest, they got the one of the highest allocation, and that itself was an alarming thing for me. Okay, so I'm not a great believer of thematic fund at the current level. I think flexi cap or large cap or multi assets, okay, fund should do very well from a if somebody is looking for lump sum money. If somebody is looking for SIP money, then small and mid also equally good, because his investment horizon is long term, and I don't see any challenges from a longer term perspective. The challenge is only from a near term, and maybe if I say 2025, whether we talk about maybe December 2025 will be higher than December 24, answer is yes. Maybe second half is better than first half, and within first half, second quarter will be better than the first quarter. So that's the way I look at the markets, and I think this is the way we understand, and I think I'm able to quantify or clarify it quite clearly.
Okay. Mr. Tandon, given that second half will be better than the first half, while we are still in the second month of calendar 2025, I want to take the probability part from you, since you do so much of quant. Will we have a happy Diwali or a painful Diwali?
See, if you really look at from a medium to long term perspective, I think it will be happy Diwali only, because you have some time. By the time the benefit which government has given in this budget, right, and which is effective from 1st April, I think consumption will pick up. So logically, you should have a happy Diwali. Why should we have a gloomy Diwali? Diwali is generally quite happy. This festival itself, I will not even like to hear that it should be a gloomy Diwali.
You know, Mr. Tandon, just as you must be receiving thousands of calls from worried investors, we also get 10s and 15 calls from a lot of people who in hindsight may have aggressively bought into the last 6 months in hopes that they are buying the dip. Now it turns out to be a sell on rise. Some words of hope, some words of cheer that you find in this dark cloud that is upon the Lal Street at this point of time?
I think I will say, every crisis lead to some opportunity somewhere. You do get opportunity. This is a very psychological game. I always try to explain people. Whenever you see extraordinary euphoria or some sort of hype getting built, that's a time we are very cautious, and sometimes. And this time also we turned slightly cautious much earlier than the market peak. So then that's a
Yes.
better strategy. Okay, I always say in identifying risk of environment, and if you can do it, then you will winner in long term. But what I have to explain that unwarranted panic is not required. Two reasons: A, India is doing extremely well in the macro front, and the budget is very good. What is the challenge which we are facing is the currency front. Okay, only on currency front, and currency is again, it's a relative term. Okay, so it's not like maybe let's say your economy has done very well, still your currency can depreciate because it's a global factors. Okay, if dollar appreciated significantly on relative basis, let's say yuan depreciated by less to counter, let's say the American tariff, and this time what China did last time also, they used their currency as a weapon. If again they depreciate their currency by 5 or 6%, okay, just to countermeasure the US tariff impact, then by default USD INR also will depreciate to accommodate that. Otherwise, China will get a benefit. Okay, so it's a very natural phenomenon. Don't look at currency in isolation. It's a relative pair game. It's a relative thing. So if India can do still very well on absolute basis, purely on relative on the currency part, we have challenges, and that's the reason FI selling is going on, because we are not affected on the currency front in terms of our return, but if the currency depreciated, they get negative returns on daily basis, irrespective of the outcome of the market. So I think this is the only risk which we have to understand, and that risk is beyond your control. Okay, so something which is beyond your control, I think I'm not saying that I can ignore it. No, as a macro house, definitely we can't ignore it. but I'm not too much paranoid about it. Rather, I look for, let's say, opportunity like pharma is doing very well, earning cycles are better, it has a beneficial export, okay, of rupee depreciation. And similarly, many more sector you can identify where you think rupee depreciation will give you sentiment booster or earning booster. Sometimes earning booster is important, but sentiment booster is also equally important. I think that's the way I would like to uh, rebuild or requantify, maybe it's up to certain, or rebalancing my portfolio rather than looking and too much stressed out about it. This is the problem. I don't think I'm in that camp. That we were in that camp in July. Okay, as I said, the risk of cycle 60% is already played out, and nobody can time it last 10%, last 20%. So I am a buyer in many names, and this is the advice. SIP should be continued. Lump sum opportunity can also be continued, but lump sum should not be done in the thematic fund. It should be more done in the flexi cap or the multi-asset fund. Or again, if you have a high risk appetite and you have a long-term horizon, then in small cap is the best opportunity. You can put money there also.
Right. Mr. Tandon, it's been a wonderful 30-35 minutes to listen to your very calm and very informative voice. Let's get together again somewhere over the next 2 or 3 months to navigate this volatility and maybe handhold a lot of new investors and a lot of worried investors who are now on the last street. Thank you so much for your time.
Yeah. Thanks for inviting us. See you.
See you. That, ladies and gentlemen, was Mr. Sandeep Tandon, one of the finest and most practical investors in the world of mutual funds. He runs Quant AMC and has 2 or 3 very important things to say. He says almost the 60% of pain in the market is over. The last 20% cannot be timed. Please, if you are in the world of mutual funds, do not stop your SIPs. For fresh allocation of capital, it makes sense to look at flexi cap funds and multi-asset funds for the immediate 6 to 12 month horizon. For the longer term, smalls and mid caps are absolutely fine. As far as pharma is concerned, he has a positive outlook on pharma and healthcare. IT, he says there is very little advantage that Indians have in this particular space, and is also pointing to perhaps a correction of 10 to 15% on the NASDAQ as well. Current levels of gold, he finds them to be a little expensive, would be a buyer in terms of extreme volatility, and if it goes down by 10 to 12%. As far as the consumption theme is concerned, he is not keen on larger asset costs such as houses and jewelries, but is keen on maybe assets that are cheaper in price, as also which have a multiplier asset, multiplier impact. Apart from that, anything interesting that I found out was in 2025, the possibility of large caps, mega large caps outperforming relatively the broader market are far higher, and of course there are early signs of exhaustion in terms of selling. This year is likely to be dominated by tariff wars, extreme choppiness, but this is where the opportunity lies to buy quality and hold quality. Thank you so much for watching this very interesting episode. I hope you enjoyed it as much as I did. Please stay glued to Business Today Television. There's a lot that's happening on the other side of the break.